The Forex market operates as a continuous 24-hour tug of war. Global buyers and sellers constantly compete, pushing prices up or down across the grid. To navigate this constant movement, you must lock down two specific variables: knowing exactly when to sit at your screens and knowing precisely what patterns to look for. Let's start with an uptrend. Notice the distinct staircase formation. As price climbs, it establishes higher highs and higher lows. When momentum shifts downward, the staircase reverses. Sellers drive price into a sequence of lower lows and lower highs. The absolute baseline rule of trading is that you never fight the dominant direction. You buy in an uptrend and you sell in a downtrend. Now we run into a common problem. This split-screen chart layout tracks the exact same currency pair simultaneously. On the left is the 1-minute time frame, and on the right, the 5-minute time frame. They show price moving in completely opposite directions. If you isolate the 1-minute chart, the price action is erratic. These sharp spikes and sudden drops lack a cohesive pattern, making this view highly prone to false signals. By zooming out to the 5-minute chart, we filter out that micro noise. This view reveals a clean, undeniable upward momentum, cutting right through the chaos of the smaller time frame. The relationship between these two views dictates your strategy. The larger time frame dictates the overall direction you should trade, while the smaller time frame is used strictly to pinpoint your exact entry. A perfectly identified trend is useless if the market isn't moving. We must consult the global clock, starting with the Asian session in Tokyo. This chart tracks the Asian session. Notice the flat line price action. The market is open, but volume is low, keeping charts slow and stable. That stability ends when European markets wake up. The City of London opens and massive institutional banking volume floods into the system. This chart shows the London and New York session overlap. The flat line shatters. Aggressive price movement breaks out, driven by surging volume bars. A technically perfect trend setup means nothing if the market timing lacks the raw momentum required to push the trade into profit. This chart demonstrates the primary danger of high volatility windows. The price breaks above a key level, triggering buyers, but instantly crashes downward. This is a fake breakout, designed to trap emotional traders. To neutralize this trap, we apply strict risk management. We place a hard stop loss directly beneath the most recent structural low, building a safety net before we enter the trade. Let's test this. Look at this dual chart layout. We are in the London-New York overlap. The 5-minute chart shows higher highs, and the 1-minute chart has dipped into a support zone. Do you buy, sell, or wait? The answer is buy. The 5-minute time frame confirms the broader bullish trend. The 1-minute chart provides an optimized entry price, and the session overlap guarantees the volume to move the market. Let's review the complete sequence on this final chart. First, verify the timing. The indicator locks on to the London-New York overlap. Next, confirm the macro trend. The 5-minute chart points decisively up. Then drop down to the 1-minute chart for the micro entry. As the price dips, we execute our entry and immediately place a stop loss beneath the nearest structural low. With the timeframes aligned and the session providing the necessary volume, the price action follows the path of least resistance, pushing straight through to the profit target. Mastering this market requires aligning 3 specific elements: trend, timing, and risk. Trade smart, manage your downside, and always learn before you trade.